Hey everybody, this is Halstead and Andrew McMillan with REH CPAs. Today we want to talk about wash sale rules. For a lot of you out there that have money invested in accounts that aren't in your 401k or IRA, you know, this is after-tax money that you just have in the markets. And sometimes coming up to year end, people will do what's called tax loss harvesting, where they sell off their losing investments to try to reap the capital loss to be able to take a tax deduction on the tax return. Well, what you need to understand are these things called wash sale rules that can affect your ability to take that loss. I've got Andrew McMillan here with me today. Andrew, what can you tell us about wash sale rules?
Yeah, so the intent of a wash sale rule by the IRS is to make sure that someone is not taking a loss on a security while still basically maintaining ownership in that security. So that's the intent behind the wash sale rules. So what the wash sale rule basically says is that you cannot, if you sell a security for a loss and you bought or sold that security or substantially identical security within 30 days, then you can't actually take that loss on your tax return. So it's very important to remember this rule, because if you are doing tax loss harvesting, like you mentioned, we have a lot of clients that do that towards the end of the year. They sell some losing stocks to offset stocks that are producing a gain, but then sometimes they still want to have some exposure to that stock in the market. They still want to own it. They'll turn right back around and buy the stock. So that's a wash sale. So if you sold a stock for a loss and then you turn right back around and sell it, and if you're within this 30-day period, you actually can't take that loss on your tax return. So it can trip people up unexpectedly when they think that they've managed their tax liability by selling off some losing stocks. But you definitely want to make sure you understand what the wash sale rules are and when they may apply.
So now whenever you do sell it for a loss and you trigger that wash sale rule, I mean, it doesn't mean that loss doesn't just completely disappear.
Correct. It doesn't completely disappear. No, you can't deduct it immediately on your tax return. What it does is it actually gets rolled into the cost basis of the purchase of the new stock. So it increases your basis in the stock. So eventually when you go and sell that stock, you'll be able to, get the benefit of that loss. Whether like if you have a gain, it'll reduce your gain. If you have a loss, it just increases the loss. So that loss on a wash sale rule, it gets rolled into the basis of the stock when you buy it again. And then when you sell it, when the wash sale rules do not apply, that's when you get to take that loss, or it offsets the gain, whatever happens when you sold the stock at that point. So it's not completely gone. It just doesn't, if you're doing it for tax loss harvesting, it definitely doesn't help you in the current year. It's more of a future year.
And thankfully, most of the brokerages kind of track that now for you. They kind of help you with that. But you absolutely need to be aware of it, because, in case if they're not, if you're working in multiple different systems and you sell it over here, but then you buy it again over here in another system, that they're not aware of it. So
yep.
You could think you're being tricky and getting to take a big loss, but you still got to keep your stock. Well, that just doesn't work that way. So if you have any questions about wash sale rules, feel free to give us a call and we'll help you out. Thanks.